My name's Luca. I've been trading for 5 years and I make $50,000 a month consistently trading futures, with last month's profits being around $53,000. And after coaching hundreds of students to consistent profitability, I realized that the reason most people are inconsistent traders has nothing to do with just a strategy or just their psychology. It's because they don't have a repeatable system that they can use every single day. Now, this is my 5-step system that you can implement today that I use every single day to consistently take payouts like this and like this. And before I get into it, I want to be as transparent as possible and show my live last week results in my P&L calendar here. So obviously you see $22,472 in the past week on my live account, and this is just me being transparent. Now, I'm not showing you this to flex on you or try and convince you that you're going to make $1 million after watching this video. I want you to understand that trading is not a get-rich-quick scheme. So if you're here for that, you might as well click off the screen right now. But if you're wanting to just become a more consistent trader and you're willing to be disciplined, trust the process, and take more data-backed approach to your trading with an actual system, let's get into step 1. So before I even think about taking a trade on the day, I need to run through my 3 C's checklist. All right, so the first C is context. I need to know what is actually going on in the market, because if I just log on and take any random setup, I might take an upside trade when the overall market context says to go to the downside. This just makes it easy to avoid stupid losses. So obviously my context on this day was very, very bullish because 1, we gapped up overnight. 2, we had higher time frame draws and liquidity, like 4-hour gaps that were up above where we opened up in the morning. So pairing overall trend in the market towards a draw on liquidity, like a 4-hour fair value gap or a high time frame draw on liquidity, is very, very important when we look at context. You need to be using the higher time frame on context because that shows you where the overall trend is going. If we're creating higher highs and higher lows and then higher highs again on the higher time frame, that means we are going to be bullish long term. For example, right here, we are creating a higher high, higher low, higher high, higher low. And I knew on this day right here, we are going to be bullish because of that structure on the higher time frame. So like I said, I want to look at the higher time frame bias and what are we delivering from? What draw on liquidity are we actually targeting? Where is the liquidity? And obviously it was the fill of this 4-hour fair value gap that I was just talking about. So to put it all together, higher high, higher low, structure towards a draw on liquidity, which is this 4-hour fill of the fair value gap. And then obviously we filled that and then made our move down because that was our draw on liquidity to the upside for the next move down. So now the second C is confluence. This happens right before I take a setup, and I'll cover more about my specific setups later, but this works for literally any strategy or setup. So I'm looking for confluences that line up right before I take a trade. I want there to be at least 3 confluences before I take a trade. So right here we have a 1-minute IFVG, we have an SMT at these lows right here, and then our ultimate draw on liquidity up here, which is New York high day. And then our draw on liquidity here, which was a 5-minute gap. Now when you're taking inverse for value gap setups, you always want to use the highest time frame available with your inverse. In this setup right here, the 1 minute was the highest time frame inverse. So why do I typically use a gap, an inverse, an order block, or an SMT before any single trade as my confluences? Is because that is what lines up my strategies, and that's what I see the most pull to in these markets. But more importantly, if I stack all these confluences like SMTs, inverses, equal highs, or higher time frame gaps, there is such a high probability that this setup works out because I'm stacking all of those. Now, I'm not ready to enter any trade yet. I need my third C, which is confirmation. This for me is usually a candle closing above the inversion and then retracing back to that fill of the inversion and then entering right off that fill, stop below the lows in the SMT, and then targeting that 5-minute gap. Let's see how it plays out. Boom, TP hit. That is one of my lowest RR setups, but this is the most safe. Now let me show you another example off of another setup with a high RR. Now this is my 3Cs OTE setup with higher RR, which we had context first, sweeping liquidity in a higher time frame bullish trend. Then we had our confluence, which was this 3-minute inverse fair value gap. And then our OTE, obviously the Fibonacci tool strategy entry model that we entered on here for a 127.55 RR right here. Stop goes to break even after breaking those internal highs. So context, sweep liquidity right here, higher time frame bullish trend. We have our confluence right here, our 3-minute inverse fair value gap, and then our confirmation was the reaction to the 705 level on my Fibonacci OTE trend. So that's the foundation. Context, confluence, confirmation. But a checklist is useless on its own. It needs something to run on. Now these 3 C's aren't a setup on their own. They're just a base underneath every trade I take, no matter what model I'm trading. Now the second I say 3 models, I already know exactly what you're thinking. Everyone else tells me to just follow 1 model. Why does this guy have 3 models? Well, let's think about it. The market only ever does 3 things. It reverses at a level, it fills the gap from the open, consolidates, or it trends and keeps going. One setup can only catch one of those. So one trick trader gets run over on every other day. So each model is a tool for a different type of day. Your job before the open isn't to force your favorite setup. It's to read what the market's actually giving you and you pick the model that fits best. I'm a big advocate in discretionary trading because once you get to the level of knowing the basics and knowing kind of the market structure, you have the eye and the experience in the market to tell where the market's gonna go. So that's exactly why I have 3 models. So let's get over with them. So let's start by going over the inverse fair value gap model. So with the IFVG entry model, I still use the 3 C's checklist. So with this, first I need the context, obviously, and it is the bullish overall higher time frame trend coming from yesterday. Really bullish. And we have a 4-hour gap as well to draw to the upside. The first thing I need is a sweep of a session low, and right here we have London low. London low is right here. So what I'll need is price to come and sweep this low before we make a move to the upside. Let's see that play out right here. Now we're going to target the drawn liquidity to the upside. But first, we need a confluence. Again, the highest time frame inverse fair value gap right now, this is on the 3-minute time frame. We have a 3-minute inversion. That's our second C, which is the confluence. Let's wait until we close above it. Boom. On the 1-minute time frame, we close above it right here. What do I wait for? I wait for a retest back to fill that gap, stops below the previous wick, and then targeting our drawn liquidity, which is New York high, as well lining up with an order block and a 15-minute gap. So what do we have here? We have the sweep of the London low, we have our confluence on the 3-minute, and then what are we targeting in this 15-minute unfilled gap, which is our drawn liquidity. So we got the closure above our CISD, change state and delivery, and then we are targeting this 15-minute gap fill right here, which obviously just hits full TP off rip. And that is an 176-point gain. You might be asking, what is a CISD? A CISD is a change state delivery. As you see here, we have a lower low, a lower high, lower low, and then we change the state of delivery after taking these bodies. And obviously stops below the wick of the 3-minute candle that we created to close above that inverse fair value gap. Now onto my next model is the OTE 3Cs model. So this is my 3Cs OTE model. When you think about OTE models, you always want to look at the key times, 6 p.m., 10 p.m., midnight, 3 a.m., all these session opens and key time openings with the higher time frame candles that are openings, right? 6 p.m., new 4-hour candle opens, 10 p.m., new 4-hour candle opens. So on this day right here, we have Asia open at 6 p.m. with this candle right here, obviously making a move to take these highs. So obviously we anchored our fib on the lowest wick right here, and then we go to the highest body of the range on the 3-minute time frame, make sure it's on the 3-minute, and then that is where we create our golden pocket right here at the 705 and the 786. And I'm still using the 3 Cs, right? Bullish trend on the higher time frames, liquidity sweep to another bullish trend. We have our confluences, which is a 5-minute fair value gap right here on the 5-minute time frame, and also a rejection block right here. So all I'm waiting for here is a retap on the 705 level, targeting the high of the range that we created. And with these 3 Cs OTE setups, you always want to target the high of the range. And with our stop loss, you want to target under the confluence, which is right there, under the wick, or under the 786. Or if it is a lower risk setup, let's say the 0.88 is about 10 points away, you can put another 0.88 as well, just for some comfort. Now my confirmation is the reaction to this confluence right here as well, lining up with the 705. With my OTE models, you want to stack as many confluences as you can to the 705 level. Let's say we have a 5-minute inverse, a 2-minute order block, a 1-minute gap, whatever it is, line it up with the 705 level or the golden pocket level in order to be bullish and create a new high out of this range. The formation we want to be looking for with these OTE models is accumulation, manipulation, and then distribution. So let's see it play out. Boom, 705, full TP right there. So as you see, we hit the 705 right here and then immediately reacted with a ton of buyers to the upside to retake this high. And that is how I caught to the tick a 1 to 7.12 risk reward. The OTE means optimal trade entry. It's a Fibonacci entry. You mark out the manipulation leg, the fake move in the wrong direction right before the real one, and then you wait for price to pull back into the golden pocket right here, which is the 705 to 786. In this case, we tapped right in the 705. Trust me, it always comes back to the 705. So this, for example, if you want to anchor it right here and then it kept going, just keep re-anchoring it to the new highs it creates. Because it's always going to come back to that 705, and if it doesn't, it's not a valid setup. you don't take it. But the reason that is, you're probably asking, okay, why? Why does it pull back to this zone every time? It is volume rebalancing. Volume always needs to rebalance before it makes that next move up. And the volume and buyers, in this case, were sitting in this golden pocket because that is what the Fibonacci is for. And at the end of the day, it is to mark out where the volume is going to rebalance, whether it's the 0.5 or the 705, whatever it is. So statistically, the risk reward outweighs the win rate by 1,000,000. Technically, you don't need a high win rate to be profitable, and a 60 to 70% is already amazing on its own. But pairing that with a 1 to 4 to a 1 to freaking 20, it's insane. Last but not least, the DGF gap fill model. This is the Duke's gap fill model that I created about a year and a half ago that I just saw so many patterns of this happening every single day on 9Q that correlates with QQQ. I just had to create a model on it. All right, so with the DGF model, there's a couple things we need, but there is always the 3 C's that we use within it. So the first thing you do, you go to QQQ. On this day, we had $4.21 gap, and that it lands in the middle of our sweet spot from 2 to 6. So it is a valid gap we can take a DGF on. Now, the next thing we do, we go back to NQ and we mark out our levels. Okay, London high is at this point right here at 35.40.25. We have a 15-minute unfilled gap at that point as well, right here. So now we have 2 confluences stacked in order for us to sweep and reclaim back to the downside towards this gap fill. Now you might be like, Luca, price is already going towards that gap. It's probably just gonna fill it. We always need to wait for our third C, confirmation. So as of right now, my only entry point would be up here once we sweep these things and reclaim back to the downside. So let's watch it play out. So as of right now, we're going towards our confluences up here. Now all we're waiting for is a sweep and reclaim to the downside, filled with our confirmation, which is the third C. I'll get into that in a second. Boom, we just filled this 15-minute gap and we swept London high. Now our third C, confirmation. This is exactly what we do. We wait for an inverse fair value gap to the downside. In this case, we have a 1-minute inverse fair value gap to the downside. Then we wait for the closure below. Okay, as you can see, we close below. Now all we need is a retest of that 1-minute inverse fair value gap. Stops above either the recent highs or above the inverse fair value gap, targeting New York lows or London lows. Because the rule of thumb is if we hit London highs, reclaim back to the downside, we are likely to go to London lows. Remember that. So as you can see here, London low is at this point right here as well, lining up with the gap fill on QQQ. So our ultimate target is the gap fill on QQQ. That is what the strategy is, but we're gonna take some partials off at this London low at around 93 points. Now the full gap fill is around 155 points. So as I said, we're gonna take partials here at that London low, or if you wanna have a lower RR setup, you can take full at that London low. But this is a good point. I'm gonna go break even once we hit this 1-minute inversion and close below it. So let's watch this play out and let's see on QQQ after if it filled the whole gap. Boom, full TP right there. Let's check QQQ. Boom, filled this whole gap on QQQ flawlessly. That is a 1 to 5.22 risk to reward, not a tick and drawdown. We went break even after this 1-minute inversion, closed below, took partials at London low, and then full TP at the full gap fill for the DGF. Now, one thing that always makes me a little bit mad about the trading space is they hand you these setups and they always tell you, just trade these and you'll become profitable. I'm telling you from experience, from someone who's lost so much money trying to start trading, they're completely bullshitting you. Because Syme was also told this, he was chasing strategies, but once I helped him lock in the psychology and the system, he was making $20,000 a month consistently just from trading. And I taught this to Syme inside of my one-on-one program. So if you want more personalized help too, you can click the top of the description. But now let's get into the rest of my system, but this is the most important part of it. Step 3, data collection and journaling. Something that bothers me a lot is when I ask a trader, why did they take that trade? Like not their setup, the actual reasons. And they have no clue why they took it. Why they lost, why they won, whatever it was, they don't know why they took it. The why is so important, and I really don't know how you can become consistent without treating trading like this. So this is why I have a strict data collection and journaling part of my system, and it's honestly is the thing that kept me profitable. For example, last year, there was a couple months where my win rate kind of spiked high, but I still wasn't seeing the results in my P&L. So I looked at my data and I saw a discrepancy in my average risk to reward. And once I saw that data, collected the data, and figured out how to execute it, it fixed that problem in itself. So you cannot fix what you never wrote down. So without the data, you're not trading a system. You're just praying that you'll magically become profitable. All right, so for example, this is my journal. This is exactly what I do and what I collect every single time I take a trade. So let's start from the top. You gotta track the real numbers, right? First, I have a section with the date, the session, the direction, the result, and time inside of the trade. Now let me explain to you why these are important. 1, you have the date so you can look back on it. 2, New York AM session because I trade differently in different sessions. Even though I am a discretionary trader, I still do have rules, so I only trade 9:30 to 11 a.m. for my AM session. Obviously, the instrument I'm trading is NQ. The model I was trading that session was the OTE, so I can have it logged on my OTE setups. I took a long, it was an A-grade setup. I won the trade. My P&L was $2,418. My time inside of the trade was 28 minutes, and that is important. Nobody really takes that collection of data with time inside of the trade, because most A+ setups or A setups, you will not be in the trade longer than 10, 15 minutes, 20 minutes, 30 minutes. Because if you're in the trade for an hour, 2 hours, that means your draw on liquidity isn't strong enough unless you're trading a 1 to 30 risk to reward. And my realized R was 3.36. Next, obviously the second C, my confluence, and I wrote down exactly what the confluences were, because again, I have to check the boxes off before I take any trade at all. Then obviously the third C, the confirmation. The 5-minute candle closed through and inverted the bearish gap right on my level, then gave a clean reaction off of it. That closes the trigger to enter long. The reason why. Why did I see a confirmation in this trade to make it an A+ setup or an A setup? Section 2 might be the most important one, so you should take notes. Just to give you guys some clarity, before I take any single trade, before I literally press buy or sell on my chart, I need to check off these boxes and write these down. And obviously in some points of your journal, you're gonna have to write it after you take the trade. So going on to section 3, the direction, obviously along the contracts I use. So this is the risk management part, and this is very, very important because you want to have a consistent risk management plan. So I used 3 contracts. I entered at 21,847. My point value was $20, obviously for NQ on a mini. My stop loss price was 21,835. My commission, obviously, just extra stuff. Okay, next section, section 4. Execution. I need to see exactly where my TP1, TP2, and TP3 are for full TP and first and second. These are the contracts I'm going to take out. These are the fill prices. These are the points, and these are the gross profits. And not only when I'm going to take them, the reason why. And then obviously my P&L. All right, section 5, the risk per contract, the realized R, the total risk, and the win and loss. Now, again, this is the template I use that works best for my data collection. And the only reason I use these metrics is because I want to keep myself accountable to stay consistent with this. All right, section 6, going to the post-trade review. Did I follow my system? Yes. What was my emotion? Emotion was calm and patient. What I did well, I stuck to my contacts, only took longs, blah, blah, blah. What to improve? Could have held the runner slightly longer to the full external high, banked TP1 a touch early out of habit. So again, I'm still marking out what I could have done better. This is the only way you can get into that process of getting better every single time. What is the lesson I learned? OTE plus SMT discount is high quality, tags OTE, SMT, discount long. And you guys know I live trade every single day inside of my inner circle, so I always have a screen recording of my trade, which I enter the link right here so I can watch it back. And then section 7, finally the last one. These are exactly my metrics on TradeZella. Use code Dukes on TradeZella for 20% off. TradeZella has always been a good data collection platform for me and journaling platform. And they're coming out with so many cool things that you can better your trading with. Now, here comes the why. Why are we journaling our trade? Why do we write down all these things if sometimes we don't even look back at them? Journaling is the non-negotiable that separates profitable from just being lucky. Once you get all this data, you can refine when you're going wrong. You can improve exponentially faster than if you didn't ever journal at all. And this is the same thing that I taught to Caden, who has consistent $50,000 months trading, Syme, who has consistent $30,000 months trading, and Milo, who I taught, which I personally am comfortable with him teaching my students for me because I am so confident in what I taught him and the knowledge he gained off of it. And if you want to learn and be a consistent trader just like them, you can click the top link in the description. Thank you for watching.